Good evening, guys. Ken at Tortoise Capital on the night of, March 22nd, 2020. The things are getting real in the U.S. right now. The futures are locked limit down right now for the opening, so it's going to be brutal again in the morning. Just a quick update on the Forex course. Dr. Morrison's working hard on that. Frank had a few good ideas to share with him. Doc Morrison's looking like it's looking like this right now: a basic course, an intermediate course, and an advanced course. They let people find their natural level, along with some more details. And then Frank has provided some additional insight. He's a Forex trader, and he's working hard with us. So that's coming. I want to just share KD's experience with the Tortoise techniques and the boot camps, and he recently leveled up in some options, and so I just thought I wanted to share some of that with you. First of all, I think you should go watch on YouTube Hot Ones. That's where the guys eat. Folks come in and they eat 10 chicken wings with increasingly hot sauce on it while getting interviewed. You should watch Shaquille O'Neal, Paul Rudd, Michael Cena, Kristen Bell, and Lisa Koshy for sure. But I would start with Gary Vaynerchuk. He is a internet content maker and entrepreneur, and boy, does he knock it out of the park. He cleans that bone no matter how hot it gets, but his insights about business and grinding and getting things done and being productive, I just thought were fascinating. Really a big fan. And I thought he did a great job on the chicken wings. He's not a guy that shies from the challenge. And his mindset is indomitable. It's indefeatable. And I think that's the kind of mental toughness that we've got to adapt. So I just thought it was really, really good. So there's a link. KD said, hey, thanks for the ideas on UVXY at beginning of March. And leveling up, and here are some options trades that he made, and I thought he knocked them out of the park. And it really made me feel good to know that I may be making a difference there, so I asked him if he would comment on if and how I have been helpful, so maybe some others could benefit from it too, because I do worry about not being helpful. And he said, I'll come up with a thoughtful answer and post it ASAP, but I do want to make an immediate suggestion. Please consider a Q&A area where we can ask questions and respond. That we did that during the online courses, and he'd be interested in doing a group of active trading together in the same way that the European crew is doing this and making real progress together in the Coaching 2020 project. So I said I will do that. We will do the Q&A inside the Coaching 2020 project on Basecamp starting immediately, and I'll combine it with this daily podcast because I'm really enjoying this. And then the active trading group, I can't make you guys do that, but the Coaching 2020 project is exactly what that thing is supposed to be used for, and the European team is using it for that purpose. We're going to go review their stuff in a minute. So meanwhile, KD followed up. He said some areas that he thought were helpful. A useful format to recognize, assess, and frame if necessary, if the criteria are met, and then engage in the market in a specific way. It's allowing him to focus on a few specific targets. He has specific goals and stops for each target and a plan to exit each situation, which allows him to ignore all the chaos around me. The chat room provides a way for serious investors and traders to assess trades and ask questions, speaking the same language and applying the strategy framework with people who are trying to achieve the same kinds of general goals in various markets. The daily and weekly reports bring us up to date on what's happening, and I explain it all just in case. It feels like you have a real edge over most of the market as I sit waiting for the market to open with my strategy written out with my plan, prepare, execute, and assess page. Yeah, if that's unfair, then that's not our fault. You've developed a real sense of confidence to move from paper trading to actual trading. I can remember in the fall saying, laying out the pathway to go from paper trading to prototype trading to limited rate trading to full rate production. And then in early March, it was ready to begin entering real small positions. And then things began to pick up on momentum. There is the overlay of the real world news. He was kind of clued in on the seriousness of the virus right from the beginning. Then luckily, I don't say it's luck, I just said it was time. You posted your successful paper trading results, which I reviewed positively and encouraged you to level up, which you've done with an enhanced sense of confidence in your abilities to successfully survive. Been listening to the federal, provincial, and state broadcasts, and then tuning in at 9 Eastern every night for the last little bit for the nightly market summary, and then that's a way to show how that news might be manifest in specific trading techniques and frames. Humbly acting as your minister of market engagement. Can be applied to his local trading environment. Interested in the new Forex program and the TC2000 bundle. Yeah, there's an installment program available, whatever works for you. I want to get it in your hands and get moving now. Then we'll just do that. Whatever terms are good for you, KD, we'll just do that. I want you to have the tools and get going. I'll enroll you in the Forex development, because if a guy's going to do the work, then I'm here to support you. That's all and I'm just grateful that things that I've been helping you with may have helped. So just a quick look. These were the trades KD employed when he was leveling up, starting early in March. Some option calls for 16K. 31K. I thought this was important to note. Leveled up with markets money, maybe too greedy with a large position due to prevailing negative news. But it was scaled at a size with markets money that was useful. So I thought that was pretty helpful to notice. I want to shift now to the coaching. So this is the Coaching 2020 project. In the student introductions is where the guys are working and introducing themselves. Getting started, the guidance on how to map your trading process. An initial guidance I put to everybody in that project that gets you started. Some mentoring advice. I'm gonna just record that and scroll. So I'm not going to read all that. The weekly questions and FAQs I'm going to come back to. So this is the location where I want anybody taking any of the home study courses to post your questions and comments there, and then I will review those daily and then try to get that into the daily strategy report. this thing on routine tasks. This, my friends, is the secret. It's what you got to be doing every week if you want to make gains. Post one trade setup properly framed in the chat room once a week. Then post one closed trade case study in the chat room with lessons learned. Complete one detailed after-action review note sheet about a trade. Conduct a weekly check-in with your accountability partner from the coaching group. Review all of the following videos. How to do a weekly report review, the swing portfolio update, that's basically the daily strategy report, and then the weekly FAQ, which I'm going to show in a second. And then prepare your notes to do a monthly XSUM. You saw the one that Glenn Osborne did. And then update your goals and objectives as a result of doing that. And then update your plan, your progress, and your plan for reviewing video lessons. That's what it takes. That's just doing the work right there. That's how you get the benefit from the coaching project. Video lessons for the advanced hybrid trading. So this is all in the coaching project. And so as I get stuff together and adding it, these are all the links to the boot camp videos, day trading case studies. I got to catch up these multi-time frame, multi-lens analyses. Dudes, that is just full of win. When you set those up, that lasts for a month or 2 months or 3 months, and it gives you a systematic view of those markets. That's what we're essentially doing on the weekend report and the commentaries where you see me drawing lines and all that stuff. But that is sort of the baseline how to get it done. And then these boot camps. Frank and Joe are working together in a partnership with Luke in Australia, and this is the material that we went over. This is they're both trading for a living right now, and both just started late fall, early winter, and their little trading mastermind. So KD, that's who I'm gonna link you up with to get going. That's who you need to be working with. Just what they're doing, just what you're doing, and these are those ongoing lessons. These are the hybrid trading background material lessons that I'm going to have the folks at Van Tharp Institute take and study for June. And these are the most current and updated ideas, in addition to the ones you hear me debriefing on the daily, right? So, weekly swing portfolio updates. I mean, I got to update these with the speed runs, but if you are on the speed run, that's all these were, and I just haven't been able to keep this updated because I've been publishing those things nightly on the speed runs. So once I get that done, I'll get that linked in there. But if you're connected on YouTube and listen to the strategy reports and you're on Patreon, you're already getting these if you're subscribed on Patreon. That's how you support the team. That's how you get the information as it's produced. This is just being documented. When I catch up with this and get it all documented in here, that's going to be for other folks that join later and want to be able to follow through and rewalk this path that we're on right now. We're living it, and that's going to be the documentation area. So when we go back to the coaching project, in the file section, that's all the different whiteboards. The file sections are all of the project area that the guys are working on. So, like for instance, this was Bill Scheit's update, pretty timely on portfolio moving average research, and just all the most updated materials from the Euro guys that are working together, and their mid-weekly market multi-time frame lens analysis, and the guys in Europe getting it done together. The team is aligning on ways to be accountable and how they're working together. So if you're in the sound of my voice and you want to work on the coaching project, that's what you do. You get together, announce yourself in there. We'll put you in a small group. And you start working together with accountability and knock out those routine tasks. And we just get on with it. That's how we're doing it. Let's go. Chats are... We're really doing those inside campfire. Messaging is sort of how to get get things working. So you can use this base camp area as infrastructure to do asynchronous, distributed, collaborative learning together, and it's very tightly connected to the campfire chat room. So that's how you get that done. The right boards are like a living wiki. So we're going to go to the weekly FAQs now. It's been underutilized, but we're going to get started with this. There was a question a while back, this may have been UKD, calculating position sizes and whatnot. This was my reply. And then today, the question was a specific one on the frog. How is the frog calculated on a gap up or down opening? And I heard the gap should be considered a big candle. Is this greater? If it's greater than the frog box, would I enter immediately in the direction of the gap, or would I wait for more candles to confirm the direction? So here's my little mini master class on that exactly. Okay. Here we are using the maximum technology to get things done. Yeah, it allows us to look at details. So here's what I want to say. Understand what the frog box is. All right, so the frog box, hold on a second. The frog box is defined as the standard deviation of range of the last 30 days. So let's imagine we had 30 trading days, and we went high minus low, and that gave us the size of the range. And then we had 30 of those. And then we take the standard deviation of the range of the last 30 individual days, and then computed one standard deviation of that. That would give us a number called the frog box. Now that frog box is the size of the frog box for the next day. So the size of today's gap has nothing to do with calculating the frog box. In fact, none of the gaps day to day has anything to do with the computation of the frog box. All we care about in the frog box is the measure of volatility with respect to the size of the daily ranges. We want to get some sense about how much do the size of these daily ranges vary. So what we're looking for then is we're looking for something that's going to have a reliably large range and relatively small variation. So the smaller the variation in the frog box, what that means is that we can rely on the trade, the daily range being a certain magnitude, and then we're using the size of the frog box as the difference between signal and noise. So if we had something where we had something like this, where we stacked frog boxes on top of each other, if that number's greater than 3, our frog quality number, then what we can say is that on average, that this trade is likely. I'm sorry, let me get that drawn better. We're going to say that on average, that thing is going to move after the open a large distance compared to the size of this frog box. So what we want to do is, in general, is we're going to wait for the open, and then from the open, if that thing moves up, well, I'm going to show it as if it moves down. If it moves down one frog box, then what we have is an indication Once it moves a frog box away from the open, we have an indication that maybe that's the direction of the day. Because one of the things that we know is that the higher low of the day usually is occurring within the first 60 minutes. All right. So when we say open plus 60 minutes, there's like a 90% probability that by the time we've seen that at the open plus 60 minutes, there's a 90% chance we've seen the high or the low of the day. So if this thing just starts failing and it moves more than a frog box, we might just say, hey, maybe that the open was actually, in retrospect, going to be, the high of the day. So if we saw that this thing moved over time, and at 60 minutes in, this thing moved more than a frog box, we might say, oh, that might have been the high of the day. Well, we don't want to necessarily wait in the slow frog for that 60-minute move because so many of these moves are happening so fast. So one of the things we then said was, let's take a look at 30 minutes in, and we'll call that the quick frog. So if 60 minutes in was the slow frog, we would say, let's wait and see at 30 minutes. Let's let the opening shenanigans happen. And then at 30 minutes in, if that thing is sold off more than a frog box, but not more than 2 frog boxes, and it's still falling, so if it was something like this and still falling, well, then I might be willing to just go ahead and get short, because now I have that frog box buffer, and then I would simply just trail it. I would get short here. If I just get short now, and then trail this with a frog box, then I could lock in my gains as I go, and then that would be my trailing stop, right? So that's the idea. So what I want you to notice is that the size of the gap doesn't have anything to do with the size of the frog box or the calculation of the frog box or a decision on when to go early or not. The only thing we can say is that the size of the gap, in this case, the close was here, and let's say that the open was there. The size of the gap simply tells us how much we can expect the size of the daily range to be. The larger the gap, the more likely there will be a large range day, because a large gap means that there was a lot of news in the overnight session to process, and so the market makers moved it far away from yesterday's close to account for that overnight news cycle. If there was no over news and it opens where it closed, then it is more likely, so there's no gap, it is more likely that the daily range would be small. It would just be like the average range. But if there was a big gap, if it gapped way down here, then there's a correlation between the size of the gap and the size of the follow-through. But it doesn't give us any insight about the direction of it. All we know is that if there's a big gap, it's going to be a big moving day with lots of range. And then that becomes a day that we love to trade. And if you think about the last 2 weeks, the intraday trades have been very powerful, but there hasn't been any way to really estimate, the size or the direction of those moves. It's been problematic, but the intraday moves have been really good. So that's the first thing I want to say. Now, the question had to do with, you had heard that if there's a big gap, we should consider that to be a candle. And I'm going to say yes on that, and here's why. So in Frog version 1.0, we waited 60 minutes for the slow frog. At 30 minutes, we said, instead of waiting the full 60 minutes to see if we could identify the high or low of the day, let's just make that call at 30 minutes and start taking advantage of those early moves that become directional right away. Because we often saw that those big outsized moves often started at or near the high or low of the day and then just were directional right from the get-go. And then if you waited 30 or 60 minutes, you missed the easy move of the day. Now, there's no such thing as an easy move, but in retrospect, it looked like, man, that sure would have been easy. So we tried a thing called the leapfrog, in which we just started with a frog box bracket on either side of the opening, and whenever price would move out of that, whether it was high or low, we would follow in that direction. So we have updated that with Frog 2.0 to call that the hybrid frog, and then all we're doing is we are simply starting the day, and now what we're doing is we're using a multiple of the frog box, and I advise starting with 0.7. You put a 0.7 on either side of the open, and then just leave it there. And then whenever price departs that box, you go in the direction of the price movement. So if it gapped down and then moved out, you would be short in that case. But if it was long, well, then you'd go long, and then you would follow with a trailing hybrid frog box, and then that sets up our chain trading, because the hybrid frog, when it is successful, means that you've already started with the first condition of the owl, and that is that you need a unambiguous move. So it turns out that hybrid frog trading leads us directly into chain trading, which starts with a hybrid frog, then gets a RLCO, and then leads us to either an owl or a P1 failure. So I'll invite you to look at the chain trading video on that one. But what I want to do is just give you a quick, not a teaser, but a quick summary of that. So here's the situation that I want you to think about. So what we have here, I'm going to move this frog box stuff out of the way. So I want you to imagine that we have that we've done the math. We've taken a look at the last 30 days and computed the standard deviation of the range, and that we did all that math, and we turned it and said that's the size of today's frog box. Okay? And then we noticed that here was the close. Just going to try to move this stuff out of the way here. So we noticed there is this is where the gap opening occurred. So now we take a look at this and we say, from that close to the open, we can classify that with our gap stat, and we would say, according to the gap stat, because this is larger than the absolute value of the average gap, we're going to call this a large gap day. Oh joy! That means there is a greater than normal probability of a larger than normal move. So what we would then do is we would take the average range, let's call this black box the average range, and then we would add one frog box to it, so the average range, plus one standard deviation. And then what we do is we call that, come on now, we're going to call that the range stat. All right, so the range stat is equal to the average range plus one standard deviation. And when we compute that, we use the size of that move as the maximum reasonable intraday move. Maximum reasonable intraday move is the range stat. And you'll see that on the daily chart for all of our standard targets. So you always want to know what that number is each day, because the frog box is calculated and recalculated each day, as is the average range of the last 30 days. That number is recalculated every day, and that's what the daily report or the TC2000 box. Now, I would tell you most of the time that if you just take the weekend report, you could use that all week, and it's probably pretty good. But one of the things you'll notice is that changes significantly when you start having all these volatile days. That thing changed pretty quick. So that's why I look at it daily. So here is a typical way in which you might put all these things together, kind of a simplified concept. Let me get this out of the way for you. All right. So let's suppose that we had the close here, and then because of news, there was a big gap down, and we looked at the size of the gap and said, according to the gap stat, that was a larger than average move. We might then take a look at the fail stat, and this is in a perfect world. We take a look at the fail stat, we say, the fail stat is the size of the average move on a percentage basis that this symbol makes before it finds the low of the day. So we measure from the open to the low of the day for the last 30 days. And then we compute that average, and we say that's the size of the fail stat, how far it fails from the open to the low of the day whenever that occurs. If we saw that the fail stat was this big and this thing sold off, and then in the first 10 or 15 minutes, for example, if from the open this thing made a new low of the day down here, so that's the working low of the day, and then we saw like a we saw a low, and then a higher low, and a higher low. We might call that a 1, 2, 3. We might call that a little 1, 2, 3 pattern. This is all in the advanced day trade course. We saw a 1, 2, 3 pattern. We might be willing, after a 1, 2, and then this breaks out to a new high, we might actually get our entry here. That would be a 1, 2, 3 entry. So that the first and the second candle have closed. It opened. Even if this thing opened like inside here and then took off, while that is an active candle, we would call that a 1, 2, 3 entry. And we might say the size of my risk might be what, a frog box or to the low of the day. What if the frog box was this big and it moved that far? We might take the 1, 2, 3 entry and then use the frog box for position sizing, and as this thing moved up, we might use the frog box as the trailing. If we had started with a hybrid frog, which is 0.7 of the frog, this thing might have gotten us in from the open. As soon as it made a sell-off, we might have gotten in right here when this thing fell, when it fell a frog box, a hybrid frog box, I should say. When it fell a hybrid frog, we might gotten short and worked this all the way down. When it started to reverse, we might have taken a profit preservation and just cashed here. And now we see a swing low is in, and we see a 1, 2, and then maybe a 1, 2, 3. And now maybe we make that entry, and now we're using a hybrid frog box to move on the way up. Or we might have said, because this was a successful hybrid frog, that's category 1 or criteria 1 of an owl pattern. And then we look for the P1, the regression line crossing the dragon. We might take the RLXD entry. So where we get in as this thing moves off the bottom, once it's moved a fail stat to the bottom, we now start having reasons to believe that this thing might actually go all the way up to the high of the day. How high could that high of the day be? Well, this is where you take the range stat, whatever size it is, you just hang that range stat from the low of the day, and you say, this thing could get that high. And that gives you this potential move from your entry. You say it could move a range stat to the working high of the day or to the potential high of the day, and that would be a reasonable move. That's the maximum reasonable intraday move. And then your risk on this one is, your risk is only from your execution risk, and then your gain is all the way to the high of the day that's marked off by the range set, and that's your reward to risk ratio on that trade frame. So when you start putting all this stuff together, you now might say, how far off the low does this thing have to go for me to get interested in it? I might have just picked something simple, like let me let it move half a frog box off the low, and then I'll use a full frog box and trail that all the way up. I might say, let me get a 1, 2, 3 entry, let me make it pull a full frog box across, or let me see it move so that the 10-period regression line crosses the dragon. And we know what that looks like. So now I can start adding some of our technical indicators, like the regression line fractal frameworks, or the regression line Bollinger Band system, or the MACD histogram seasonality, and start buying it in the spring. So we can start adding additional pieces to how we want to manage this, what turns out to be the first interesting. This whole area in here is just a very interesting. This whole first 30 minutes or 60 minutes or however far out you want to go, this whole opening hour is really where the hybrid trading, hybrid frog or chain trading, or the different techniques we teach in the advanced day trading course, all of these things can be applied. We can use something as primitive as the WMB3 technique. And this is really what goes beyond the limits of what I can talk about in this one. But that's what the advanced day trading course is all about. Now, when you start looking at some of the swing trade time frames, this is what the swing trade course is all about. What kind of price action in the previous day and previous couple weeks make me interested in this tomorrow as a swing trade? When I start linking both of those things together, the swing trade patterns and then the day trade patterns, and I start linking the swing trade time frame to the day trade, now I have advanced hybrid trading, where I'm using swing trade patterns to give me high quality swing trades that could move large tomorrow, and then I add to that some of the sensibility of the, that first 30 minutes or 60 minutes, and using day trading techniques to improve my swing trade. And if I do that, I might be able to actually buy this, early, using day trading patterns, and then if it starts moving nicely, I can take off the day trade and cash 80 to 90% of that, and then just keep the residual and get a really nice swing trade entry and use markets money from this nice big move to pay for the overnight risk. And that's what we mean by advanced hybrid trading. So I wanted to say all that simply to answer KD's question about the frog box and what happens with the with that great big candle. So in the case of the large gap, when we talk about the owl, that's really where that whole notion came about. Is in the owl pattern, what you needed was, from the open, you needed a large directional move, an unambiguous move. Well, one of the things that we decided made a lot of sense and really pays off well is that when you consider this large gap, just treat that like a large red candle for the unambiguous move, and then if this thing does continue to sell off and then starts to get sideways on you, and then starts to move up, now you have the unambiguous move that you need to trigger the owl pattern. You don't have to wait for the intraday move to be large, because it might start turning right away. And you say, well, I have to wait for it to make an unambiguous move off the bottom to get in? No. The fact that there was this enormous move down from the gap opening tells you that this thing is already in play, and that's the only reason we needed to have a large unambiguous move to get into the owl, because the owl is a trend reversal trade. So the fact that there was a big gap down, and then this thing sold off quickly, like a fail stat, and then started to move up, that now allows us to start getting into our owl patterns, or if the owl fails, it gets us into the collapsing dragon or the P1F. So the fact that you had a very large move in the gap tells you that this thing is in play for the day, and that's why we're going to see a bunch of that stuff tomorrow, because there's going to, right, if nothing changes, there's a limit down in the futures, so there's going to be a huge amount of emotion at the open, and that's perfect for the hybrid frog and the chain trading, where you just start with the wherever it opens, and you put that hybrid frog box on it, and then you play in the, right from the open, you start playing the directionality right away, because the size of the gap tells you that there's an implied unambiguous move. A limit down gap opening, that's an unambiguous move, my friends. Okay, so that's everything I wanted to cover today. KD, did I answer your question sufficiently? I'm going to assume that I have, and I'll let you listen to the replay, and then I'll just point you at the chain trading lessons that are in the coaching project. Already has a lot of these already built out again, so I just wanted to catch you up to speed on that to help you be ready for tomorrow. So that's everything I wanted to cover tonight, guys. I posted the weekend report review already, so that's already on Patreon. This will get up on Patreon as soon as I can get it processed. Oh, wait a minute. There's another follow-up question. Hold on. The hybrid frog starts from the open. Okay, so here's what I want you to say. The hybrid frog starts with wherever this thing opens. Let's say there's a big gap open tomorrow, which there will be. All right, so let's say a gap open from there. What you do is you take that 0.7 hybrid frog box and you put one on the upside and then on the downside. And now, at the moment of the open, you have simultaneously the high of the day and the low of the day. And then if this thing goes up from the open, a hybrid frog box, you are long. You're long right from here. That's where you're long. But if it leaves that hybrid frog box on the downside, that's where you get short. And then you use that 0.7 frog box as a trailing stop. Okay? God dang it. Here we go. So the hybrid frog box is a straddle on the open. And it just says, as soon as it moves 0.7 frog box in either direction, that's the trade you take. And then you follow that. If it starts going up, that's where you just follow it with the hybrid frog box. And as soon as you can, you get that thing to no lose plus dinner for two. So let's say I was using this red line as my stop. Okay. So this thing goes up and it gets that far. Then as soon as it gets that far, I go ahead and I move my stop up from here now to here. And now I've locked in no lose plus dinner for two, and now it's a science project, okay? And the same thing works on the downside. I just move, as soon as I can, I move my stop to no lose plus dinner for two, and I take my risk out of the market. And now it's a science project to see how much I can earn, okay? So, take a look for the chain trading flashcard and videos inside the Basecamp project for coaching, and in the boot camps. That chain trading flashcard is the key. Let me see if I can find it here. Yeah, I have a better flashcard. If you don't mind waiting a half a second. Yeah, here's the video, the chain framing. Ah, there it is. Chain owl flash. Ah, that's not the one I want either. But this is essentially what... I have a better one. I'll find it and post it. Yeah, so there was the close. Here was the gap down opening. This thing sells off. So when it moves a hybrid frog box off the open, we're short. It comes down. It comes into an RLCO. So somewhere in here, you end up taking the stop to lock in the win. And now you had a successful hybrid frog. That's, by definition, the unambiguous move. And now you get the P1. That's condition 2. You get the RLXD. You can actually buy that one. But then as soon as the dragon rolls up and the RL30 rolls up, now you have the owl and off you go. But if this thing fails, like this, it comes down and the owl fails, instead you get a collapsing dragon, and that's the P1 failure. All right. So chain trading consists of a hybrid frog that begins with an unambiguous down move, and then that comes into either an owl for success or a P1 failure if it fails, or it might just morph into a sideways quiet channel, which becomes a Z3P. Here's a perfect example of that one. So this one happened to be this would have been a hybrid frog. Let me show you where that one works. So this one would have been something like a hybrid frog trade here. And then when it fell that far, your hybrid frog short, it failed again, so you put a second position. This thing failed all the way down until it came down to a P1, which is that down in here is where you get the P1 outside the river. Then you get the RLXD. The dragon rolls up, the 30 rolls up. It becomes an owl. The owl began to fail, so you cash it, and now you're going to find out from here, is the owl going to continue? In this case, if it gets above the hump of the dragon, I get long on a continuation play. Or if it fails below the belly of the dragon, that's a P1 failure. And now this is like, if it doesn't do either one of those, it just mucks around sideways. It becomes a sideways quiet channel. So there we are. Okay. So that's the pattern I'm trying to teach. That's chain trading, hybrid frog trading, intraday trading that is perfect for very volatile days. And it just starts with wherever it opens, you put that hybrid frog box on it in either direction, and then you just follow price. It couldn't be simpler. Okay? But even the simple things are hard in life because, emotions and ego and all that stuff. So there we are. Okay? That's everything I got for tonight, guys. Take good care. We'll see you in the chat room.